Fundraising is important for any founder to get their company to the next phase. Whether it's taking the product to the market, scaling, or growing sales, having a healthy cap table is crucial for encouraging the future investments. And we can do this by modeling each of the scenarios out and also visualizing the potential outcomes. So that way, founders can make a better decisions and be in a better position to negotiate with the investors. So what I have here is a cap table model. We will be going through each of these stages and how I would be inputting the numbers to understand what is the shareholder percentage through each of the fundraising round. So I've went ahead and put in two founders, let's say Jamie and Frank. Let's say they started the company out at $30,000, and they both negotiated and said, all right, we're gonna give each other a million shares. All right, so 50-50 going into the company, building out their products and looking for an angel investor to come and invest in their proof of concept. So you can see here that if you scroll down a little bit, you'll have an overview of the shareholder percentage, also MOIC, which we'll go in a little bit later, investors value, number of shares, as well as the detailed breakdown of who owns what and how much. All right, so let's say they go to an angel investor and they're asking for $200,000. No cap, no stock option pool for the moment. And let's say we put in we approach the investor for let's say a 1.2 million valuation. So you can see that the model spits out the numbers right away for you, that the post-money value is 1.4. You can see that the investor that you're approaching gets a 14.29%. You dilute down to, use a founder, dilute down to 85%, but immediately you take in a 40% MOIC on paper. Of course, this is not have an exit yet. And yeah, you can see other important information. But really what you want to be looking at is what is the founder versus the investors, because that's really crucial as you get closer to Series A. You really want to have at least 50% post of Series A when you get to that round. All right, so you have a proof of concept. You're ready to grow the business, to grow sales, grow customers. You go out and you reach out to a seed investor for, let's say, $1 million. And let's say you went and approached them with a $5 million valuation. Let's see what that looks like. So 6 million post valuation, 71% to 28% of total investors. Still looks good. If you go down a little bit more in detail, you can see that the seed investor has 16% for this round, and the angel investor diluted down to 11%. Seed investor came back to you and said, all right, 1 million for 5 million pre-money valuation. It's great, but we need to add in a option pool for the employees to ensure that they're highly incentivized to get the business to where it needs to be. So you can come in here and say, all right, well, we're going to put in 100,000 shares for the option pool so that we can distribute to employees. And you can see how that dilutes the shareholders, as well as gives the stock option a 3.4%. So one thing I want to point out here, since this is a simplified model, a very easy model to do, it's also means that there are some things in here that I needed to make a fixed assumption. In the stock option pool, ideally when you get into negotiations, this is a part that you would negotiate whether the dilution happens after the money comes in or it happens before the money comes in. So in this model, the dilution is going to be happening before the money comes in. So it's investor friendly. So that means that it's going to be diluting the founder as well as the previous shareholder before the seed investor. So if I go back and put this to 0, and you take a look here, you can see that the founder and the angel investor have 71 and 11% respectively. And if you go back here, say you issue out 100,000, and look at here, and you can see that the seed investor still holds 16%. Angel and founders are the ones that get diluted down. So this is investor-friendly approach when you are issuing a stock option pool for each of the rounds. All right, so let's say we get into Series A. Let's say you do 10 million, and let's say the pre-money valuation for 10 million is $50 million, and you do another 100,000. You can see how that affects the founders percentage, and the stock option pool goes up to 5.5%. So, basically this is pretty much forecasting how the dilution of shareholders will occur for each round based on the valuation that you could be pitching and based on the capital that you're going to be asking for. So I'm going to go ahead and finish the rest of this just so that we have a complete forecast of the company. 120. Let's say here we do 75 million, and we do 900,000. Oops, that's wrong. I wanted to do that here, and then we could do the valuation for Series B. Let's say 250. All right. So we have a complete storyline of where we would go from Angel all the way to Series C, and what the ownership of each of the shareholders will look like. Use this as a negotiation tool and really to kind of guide yourself to getting from the inception all the way to the most important round, which is the Series A. Because most companies don't get to Series A, and getting to Series A is a big deal for any startup business to get there. That's a quick overview of how to use the model. There's some other tools in here that I didn't go over, such as convertible notes, and that is going to be covered in another video. All right, thank you.